All right, what's up, YouTube? Happy New Year! Happy 2018 to everybody. Hopefully, everybody has those 2018 goals set really high. Today is a special video, just like every special video on this channel. Trading M&W formations. We're back at it again. All right, I have not done a video on trading M&W formations in a while, and I know there's been a few hundred subscribers since our last video on trading M&W formations, so I'm just going to make this one and go super in depth with everybody. Today was NFP. It was a beautiful NFP. We made thousands of dollars. Everybody had a great NFP. If you're in our channel, forexcommunity.online or forexalerts.online, you can find these alerts or signals, whatever you want to call them, that we're sending out. Basically my analysis on the market. Now keep in mind, I'm not a financial advisor of any type. I just learned this method that I'm about to teach you by looking at the graphs. That's all I did. All I did was look at the graphs and backtest this over and over and over for a few months until I became consistent. And now I have been able to, thankfully, for a few years now, not even have a job. I've been able to live off the profits from the Forex market. So I'd like to teach you guys how to do the same. Now, trading M&W formations, we've all been there. We've seen the M's, we've seen the W's. You can see them all over the charts here. How do you trade them? Once you see the concept of why they form, once I tell you why they're forming, your mind will be blown. You'll see the charts in a completely new way. Now, to start this off, hopefully you all have a general understanding of the market. If not, this probably isn't the best video to start on, but I guess you can stay tuned, Here is a very good example of an M formation. Now, why do I say this is a good example? If you are on TradingView, you can go to time scale and click on session breaks, and you can see the day markings, the daily markings right here and right here. These blue tracers every day. You can see this work in here is 1 day. So we know there are different sessions in the Forex market. The main session that we really focus on is the Asian session, because the Asian session is where the consolidation happens. Now, consolidation is probably the most important aspect of Forex, you guys. I know you hate it. I know it's really, really annoying when the market is up and down in one tiny area and doesn't really move. It just stays in one price range. But this is where the magic happens, okay? If consolidation did not happen, the market could not do what it's supposed to do. That is, trap people and blow their accounts, basically. All right, take their money. So, how is this even possible? All right, to understand how this is possible, we have to understand how a retail trader trades. Now, we've been there. I've been there, okay? I trade as a retail trader every day. So I'm constantly in my mind thinking, how would I take this structure as a retail trader? Where would I position myself as a retail trader? Now, what do I mean by retail trader? I mean the knowledge that most retail traders know. That is, consolidation. A lot of retail traders place buy stops or sell stops under or on top of consolidation. We know that. So, or at the high or the low of the day or the previous day. So, here's the previous day right here. This is the previous day. Now we have the low of the previous day and the high of the previous day. Now, here is the Asian consolidation of the previous day, and we can see the consolidation worked the low of the day and then created that W formation and came back up. Now, this W formation is the exact same. I guess it's the exact inverse of the M. So there will be consolidation, and then there will be a breakout of that consolidation, whether it be even for 1 pip. Okay, it can be a 1 pip stop hunt plus spread. Remember, spread is sometimes 5 pips on some brokers. 5, 8 pips, even, 10, 20 pips, depending on if there's a news event. So the spread is really important, you guys. Now, I'm not saying you have to look at the spread all the time, but it's important to see and understand when the market is being manipulated. Now, we can see the low of the day was created here, and this candle broke below the low and left 1 candle here floating below the low of the previous day. That not only confirms to retail traders that it is a sell, but that also is a confirmation to a lot of trading EAs and robots that people have programmed to set as a confirmation of a breakout, a candle opening below the low of the day or of the previous day's high, like we're going to see here. So it's all a trap, you guys. Okay, this is a trap here. This little candle, that little candle right there, is one trap right below the low to induce the retail trading herd to sell. Now, let me explain a little bit more about how the retail trader trades, how we were taught to trade. Now, we were taught this, you guys. Like where did we get our information? Okay, why do 90% or more, I think it's like 98% of retail traders fail? Why is that? Because they're all using the same information. They're trading breakouts, they're trading momentum and all these different indicators. We don't trade indicators, you guys. We trade structure, okay? And it gets very easy once you understand market structure. So here is the Asian range. Now, I've done a lot of videos covering the Asian range, and I'm not going to go over it right now in this video, but if you'd like to learn more about it, check out our previous videos on trading M&W formations, or we touch up on it on basically every video. Asian range is the consolidation, the trap zone, the trap basically where the money is trapped. And just so happens that Asian range stays in consolidation. Meanwhile, the U.S. session is going on. Excuse me, not the U.S. session. The U.S. is just waking up, and they're starting their day out. So it's daylight for people in the United States, unlike in New York session where it starts very early in the morning. Sometimes it's not even light out. And in London session, obviously we know that's 2 a.m. for most people in the United States. So there's a lot of liquidity being pumped in Asian session from people trading in the United States during the daytime when they're, day trading. So we can see Asian session just consolidates and traps these people, these retail traders, in this chunk. That's what I like to call it, a block of consolidation, or this chunk. And when they're trapped here, what did we say? What did I say before? Retail traders place their buy stops and sell stops above and below consolidation. So imagine 5 to 10 pips above this consolidation, there is a chunk of buy stops and a chunk of sell stops, right? So what does the dealer have to do to activate those orders? He has to do what we call this whipsaw formation. This basically kind of like a heartbeat monitor, goes like that, bump, 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 bump. But it's going up and down. It's going down. The market goes down to activate the sell stops here in this area, and it goes up not only to hit the stop losses of the sell stops that are in here. They have their stop losses above the high here, but they also activate the buy stops. So there's a lot of stuff going on at one time, but once you understand it, it becomes really easy, you guys, because it's just this. This is the only thing, okay? This is really one of the only structures that you need to understand. This happens in micro and macro. Now that means it happens in large forms, in large structures, and it happens even on the 1 minute chart. Okay? So, but this is the main structure that is going on here. It's the trap, activate, and stop out. Okay? We can see it again right here. And I'll show you guys how the M formation plays into effect here. This is the consolidation as we know it, and then there's the buy stops up here. And because it's also, this is the high of the previous day, there's even going to be more buy stops up here. So take that into consideration. Now this is what I mean by thinking as a retail trader. Where are the retail traders putting their buy stops, their sell stops? Where is the liquidity at the time? Now, you don't have to get your price projections perfect by any means. What you want to do is, once you see something like this big candle right here, what is this? This is activating those buy stops that are above this consolidation, which is also the high of the day, and right here above the high of the previous day. All those stops, all this liquidity was activated, is now in the market. That money is now in the market. Now, what happens? Whoops. All right, the dealer comes out of that consolidation, comes up to activate the stops, then comes down, then comes up one more time. What does this look like to the retail traders? If you couldn't already see what's happening. All right, let's say we're trading this right now in live as a retail trader, and none of this red happened. Ooh, thank you, whoever subscribed to the website. Woo! All right, so here's the low, and then we can see it looks like a continuation of this uptrend, because we know that an uptrend is creating higher highs and higher lows. So that is the definition of an uptrend to a retail trader. So here's the low, here's a higher low, here's a higher high, because right here's the high of the day, and the high of the previous day. So we're already creating higher highs. Comes back down, creates a higher low, another higher low, and then comes back up, creates that higher high. Now, to a lot of retail traders, this is the confirmation to get in as a buy, because they had right above this candlestick, right here, were buy orders. Above that candlestick. Now, I don't have any special powers, you guys. A lot of people think I'm a wizard. I'm just going by the market structure, okay? This is all I'm doing. I'm just following what I believe is the liquidity by what we were taught as retail traders. I'm doing the exact opposite of what we were taught to do, okay? And that's all it really is, to do basically the exact opposite of what you're taught. We're taught to buy the higher highs. We're taught that a higher high is a continuation of an uptrend, higher highs and higher lows. Now, obviously that is true to a certain extent, but we can see it's also used against us. Now, a perfect M formation, this is the confirmation candlestick pattern that we use. We can also see a little head and shoulders pattern right here, but that confirmation is the railroad tracks above the high, or whatever you like to call it. This is our confirmation to enter. Okay, you could have entered on either on this candlestick, right, the first leg of the M, because it was actually to the high here. We already know what's going on. They're grabbing orders at the high, but they gave you a second chance. And that's what's really amazing here, is that they gave you a second chance to enter, but also gave retail traders that confirmation that it was going up. And we can see right after that, 2 candles, and then that shift out of that uptrend right here. And then that's what basically caused that avalanche of buying up, right? It's the pump and the dump. You buy it up, and then you sell off. You being, I'm talking about the dealer, right? He buys it up, and then they sell off, the whales. So what's good about this is that this is really the only structure that they use, or that they can use, because it's what we've been taught, and it's one of the main reasons why they can make so much money, is because we've been brainwashed to believe to play their game, okay? And now their game is up. We know how it's played. Check this out. This is unbelievable. Asian session. We know Asian session starts at this blue line right here. It starts about 8 hours before and continues 8 hours after the session changeover, which is this blue line. So we can see the dealer went into consolidation here, and then what happens? The same thing. Hit stops up, hit stops down. Continue the day, leave the day off in consolidation. Consolidation. Asian session, hit stops down, come up, consolidation. So it's really the same structure being played over and over and over and over and over. You just have to realize that it's all about the consolidation, where the trapped orders are. Okay, we can see the small M formation right here. This is a valid M formation. We can see it happened. It looks like it happened right at the start of London session, which we've talked about in a lot of our videos about M formations, that they form London session or New York session. That the second leg of the M a lot of times will form in either the London or New York session. So this second leg of the M here was actually hitting that, I guess you could say, the first leg of the M, but it's also the high of the day at Asian session, and then they drag the market down to hit the any orders below the low of the previous day. So here's the low of the previous day. We can see that one big candle. That's your confirmation, you guys. Okay? This candlestick right here that goes below this low, you know what it's doing. It's taking out those stop orders that are below this low. Why is that? Might as well show you guys what I made here. Alright. The downtrend, we know, creates highs and lows, lower lows, and lower highs. The uptrend creates highs, lows, higher highs, and higher lows. Now, there has to be a point at which the trend stops, consolidates, and either continues or reverses. Okay? This is the tricky part. Finding when the trend is going to reverse. Now, this is what it looks like when a trend is starting to reverse. The trend, instead of being very steep and going up, will start to, it'll still make higher highs, but it'll start to consolidate off. Okay? It'll start to kind of fade out. We can see it starts to, it's not as steep. This trend isn't as steep. It starts to kind of consolidate in a chunk, and we know what that means. So here is an example of that. Right here we can see that very steep, about 4 days, 3.5 days of uptrend, very steep uptrend, and then there's that consolidation right there. Consolidation here for about 1.5 days, and then here's that sell-off. Obviously, it wasn't a huge sell-off, but it was still a sell-off of this consolidation that happened here after this very sharp uptrend. Now here's a lot better example. This was actually news-induced sell-off, a bit of a sell-off. We can see that very sharp uptrend once again, and then that consolidation here. It's still uptrending though. You can see this high, and then that higher high, and then what happened today was very special. Ask yourself, where is the money and how is it reacting to the market? So where are the retail traders and how are they reacting? Where is the consolidation? How is the dealer going to structure the market according to this consolidation and according to the highs and the lows of the day, of the previous day, of the week, of the month, all these highs and lows you have to take into consideration. So consolidation is money. It's where the money is. Now, let's go over NFP today. Today was a very, very, very good day for us. NFP, we smashed it, okay? It was perfect. It was a beautiful trade, beautiful setup, and I knew exactly what was going to happen because of what I've learned and everything I'm telling you right now. You'll be able to understand why NFP, why the move was made the way it was, this NFP. Now, it was absolutely stunning. It was beautiful. Here's the high of the day, or of the previous day. And let's go back here. Here's the high of this previous day. Here's that M formation. And then this is a news. This is most likely a news event that created this spike up to the high once more. This is what a lot of people call a triple top. So why am I talking about this? Why am I going back to this? Notice that there was the high of the previous day that was created here, and then this either M formation or triple top happened here at the exact high of the previous day. Now, let's go here, and how is this not any different? The high of the previous day, Asian session consolidation is working the high of this previous day. Now, it obviously wasn't to the exact high, but we're still at the high of this previous day. We're very, very close to it. Open the spread up a little bit and you'll get extremely close. And I'm sure NFP had a very, very nasty spread on it. Maybe not Euro USD, but a lot of pairs. For these high impact news events, we know the spread is manipulated. So here's the high of the day before NFP. An Asian session created that high. Now price came down, and if you are in our group forexalerts.online, this was basically my analysis. Literally, that was my analysis when price was right here. It was minutes before NFP. I sent this out. Price did exactly what I expected. Now, why did I expect price to do that? To go spike up to the high of the day, basically, and come back down. So we can see the the W formation, triple bottom here, right before the announcement for NFP. This was at 8:30 in the morning. NFP came out. So at 8:25, I sent at something like 8:28, I sent my final analysis on NFP, and I showed you guys a spike to this high. Why? Why did I think it was going to be a spike to the high? So this spike was once a big green bar. It was a big green candlestick. That is very, very, very hard for retail traders to, I guess retail traders look at NFP like a day to make free money. A lot of retail traders, a lot of people in these network marketing schemes with these leaders, traders, whatever they want to call them, that basically risk their entire account for NFP. These guys are claiming, you buy into these big candlesticks, or this is how you trade. You trade as if the market is always going to go your way. As if, this green candlestick that was here at one point is always going to be green. It's always going to go your way. It's not like that, you guys. Okay? Once you know this, though, once you know how the market reacts to the highs and the lows, you'll understand everything. So, the wick to the high of the day. The high of the day was made here for in this consolidation Asian range. We know there are orders at this high. That green bullish bar induced all these retail traders into that buy. And then we can see the sell-off happen. They pulled a big wick here. All this, there's millions of dollars, millions and millions of dollars trapped in this wick, you guys. From retail traders that bought into this, thinking that this uptrend was going to sustain itself. We can see it did not, and it fell off. Fell off a cliff. Basically, I believe that was around a 30 pip move. We got in at 1.2080. And just this candle right here within the first 30 minutes got us about 30 pips in profit. Within two candlesticks, 15-minute candlesticks, we had 50 pips of profit. Very easy trade. Just trading the highs and the lows. This is an M formation right here off of the high. Beautiful trade. So, let's check out another. Actually, let me show you guys. Let me commentate a little bit of some pre-existing data. So, what I did to become so good at how I am at this was basically going over pre-existing data and backtesting. Why did the market do what it did? Why did price move where it moved? Why did the consolidation consolidate here? And then where do I think the retail traders are according to this consolidation, the highs and the lows of the day, the previous day, and whatnot? So we can see here, Euro created this triple top, but almost a quadruple top. Now, before I start talking about this, I missed something here. I'm sorry. A lot of times, I do not trust a triple top if the third leg of the triple top is something like this, where it consolidates up here, and this would be maybe first hit, second hit, and then the third hit, but yet it's still consolidating at the high. Most likely, it's going to do that. Price is going to break the high and move up. But if we have a triple top that is induced by a news event and moves very, very fast, so for example, this third hit, first, second, and then the third hit to the high here is very fast, very sharp move. So for example, right here, here's the high. We can see this first hit maybe to the high, and then high, second hit, and then this is the very sharp third hit to that high. Here's a better example. first hit, second hit, and then what I believe is a news event right here, or maybe it wasn't a news event, but a lot of times news events are used to create that, induce that stop hunt to the high or the low. So here we go, that trap move, very fast. That was very fast. Came up very fast and then came down trapped just as fast. And then actually used a gap to jump from this zone to down here and consolidate and hit any stops, jump over any stop losses. You know what they do. So here is the Asian consolidation. Breakout to the low, activates sell stops. This wick breaks out to the high, activates the buy stops, and then price continues. Consolidating. Ooh. All right. Consolidating. And basically doing the same thing. Consolidation, stop hunt high, come back down. So we can see this is a very, very continuing theme here in the market, this whipsaw structure. And this is used in conjunction with M's and W's. Here we can see this is another very, very common theme here, where Asian session either creates a high or a low. So here we can see Asian session created this high here, and then they came off of it, and then London session starts up, and suddenly they're interested in what's up here again. They're interested in this high once more. They spike to the high and then come back down, inducing people long, inducing retail traders long, and creating that M formation. So if there is a second leg to the high or the low of Asian session consolidation that happens during London or New York session and has this same structure or looks similar, a lot of times they're trapping orders at either the high or the low to then reverse and take their money. So here's this little M formation. Now we've talked about the structures coming in macro and micro forms. This you could say is a small micro M formation. We have the consolidation here, the breakout of consolidation in this one candle, and then that M formation to then reverse the market. This is how I became what I am and how I trade. Okay, this is all I did for months. Not years, because that's technical analysis, and that is the retail trading way. You know, they tell you Forex takes, 5-10 years to become consistent. Yet how am I able to do this for you guys, to show you this, become consistent in just a matter of months, and yet they tell you that's impossible. The same people that say it's impossible are the same people that are feeding you the BS methods of trading. Okay, here is this, another W formation. We could actually call this a triple, maybe a head and shoulders, but Head and Shoulders is also a triple bottom with that sharp third leg to the low, and then they came up off of that low, Euro US dollar. Now, I talked about confirming candlestick patterns. If you don't already know what confirmation candlestick patterns we use, please look at our previous video on confirmations and some of the confirmations we use. This is one of them. Like we said, the wick and the railroad tracks here. The two, one up and then one down. We use that as a confirmation a lot. So if that candlestick right here, for example, closes below the high, that is considered a valid entry for us. A lot of people actually, myself included, sometimes don't even use the confirmation. This confirmation, we actually go earlier into the trade because we know already what's going to happen. We know that there are buy orders above this high here, and this candlestick here we know is used to hit those stops and induce retail traders long, and then we go short on this candlestick even before this confirmation candlestick completes itself. So backtest, you guys. Backtesting. I know a friend that took this trade. Very beautiful trade. Very beautiful M formation. This was once a big green candle. Remember that. This wick. Once a big green candle above this high. What's it doing up there? And this is probably most likely a news-induced trap right here. It went up to activate the buy stops up here, inducing retail traders long when they saw that big green candle, and also also hitting the stops of any sellers that may have sold anywhere in here so that they do not get this money when they finally reverse the market on them. So this M formation, like we said, it is used to induce long. The exact opposite for the W formation. It is used to induce short. W M. Now let's check up on and also here's a good example of the macro. Very, very big M formation going on right here on the daily candle. So, like I was talking about, you have to take into consideration as well even the daily, the weekly, the monthly highs and the lows, because the dealer uses that in macro to obviously structure the market, structure the orders around the market. Now, we may see Euro USD come back off of this high, which it looks like it's going to do, and come down, but we also have a wedge formation here which may actually break out to the upside. But if we have one more candlestick, if the next daily candlestick actually comes down and shifts the zone I would say below 1.195, we should have a confirmation that the Euro USD will go down, will continue to go down to at least, I would say, 1.175 or even 1.16 or lower, because it's been in quite the uptrend for the past few days, few candles for the past few months, and now we can see, like I've talked about, the sharp uptrend and then that consolidation, yet it's still creating higher highs. So that has all the potential to reverse yet. So let's go on to another chart, another graph. NZD US dollar. We have a very similar formation here. I also wanted to talk about the holiday chop, which was affecting a lot of pairs. Basically, over the holiday, not many people trade. So the dealer knows this, and I'm not sure if there's actually a conscious human dealer. You know, they could actually have an AI or some type of very advanced program that is actually creating these structures, but they could also have a dealing desk with a lot of people at it actually taking and making these, you know, art forms of art. But anyway, what is the holiday chop? It is where the market basically, there's very little liquidity, so it has to make up for that and create a very large sum of liquidity in one zone, and it stays in that zone for a very long time, an extended period of time. Now we know the market was closed for a few days in between New Year's and Christmas and whatnot. We can see actually on GBP JPY there was even a longer extended chop period for a few weeks, actually, a very long time. Here was the Christmas chop, and then New Year's it kind of broke out, but yet stayed in that area, and now finally we can see it's moving out of that area. But we can also see possibly our signature trade. Speaking of our signature trade, let's go over that. That should be in this video. It is a beautiful trade. Let's see if we can find some signature trades of ours. The signature trade, if you didn't already know, we created this trade, we made it up, and basically it is, here's a very, very good example. Okay, it's based around the M or W formation, but also takes into consideration the wedge formation. Now, how does this work? So the wedge formation will form, and the second leg of the first leg of either the M or the W will be the low of the wedge, or the start of this wedge, right? And then the breakout of the wedge will be the second leg of the W or M formation, depending on what you are trading. So here is an example of this. Wedge formation pattern, and here's that low. The low was created here, and here's that wedge formation that started, and then the second leg, the breakout, right? The breakout of this wedge is what creates that second leg. Now this is a lot of times it actually happens like this, like where it's instant. A lot of times it won't actually consolidate here for this long, but that is just a different variation of our signature trade. They come in all different types of variations. They can't do the same thing over and over and over, because the exact same structure would obviously, people would start to catch on. So here's that wedge formation with the breakout to the low, and that second leg of the W is created upon breaking out of that wedge formation, which also induces sells, and we know what's down here. The sell stops as well below this low. So that's our signature trade. Let's try and find another. They actually happen a lot. Sometimes they're not perfect, but we can see right here. Here's a good one. Wedge formation. The low of this day, the low of the previous day, and then the breakout of the wedge formation created the low of the day, which was also at the low of the previous day. So that is a valid W formation. Here we have another. This one could be a little better, but I would still say it is a wedge formation breakout, our signature trade. The low here, and then the breakout happens, creating that W formation. And then we can see a lot of times this comes back up for lots of pips. I mean, this is over 50 pips if you catch that. That's 130 pips if you catch all that run off of the low right there. And I mean, that's the exact, this is no drawdown, you guys. Absolute drawdown will be a thing of the past if you can catch these right. Okay, you can, if you have the patience. Now, that brings me into our next topic. Risk management with these trades. I see so many people making so much money and then losing it all a few trades after they made their really good trades, because they don't know when to quit. They don't know when to stop trading. So this is where the risk management comes in. I'm not going to tell you guys how much to risk percentage-wise. That's, I guess, I risk sometimes between 3 to 5%, sometimes more if I feel really confident in the trade. But even that is quite a bit to be risking per trade. Now, I would suggest, if you're new to this, new to trading and everything, and you still want to start with this and want to try this out, I would suggest creating a $100 account, or the best would be $1,000 account if you can afford that, and then just using 0.01s. 0.01s. Do not do a demo account, because a demo account, if you want to start a demo account and then you get good and then you think you can put in 10 grand and do a real live account, that's BS. The demo accounts were created to promote that BS, okay? Because it's not real, okay? There's no real attachment to the charts, to the structure, to the market, okay? There's no money involved in demo. So this is why, even though it'll be a $100 account or a $1,000 account or a low amount, and you'll be trading with 0.01s, it's still real. Okay, you'll still understand, you'll still have feelings for your trades, and you won't want to lose, because in demo it's not really, you don't care if you lose. So that's the whole point here. Becoming consistent with 0.01s, not using demo, consistency with 0.01s, and then building your account from there. Okay, I suggest taking one trade a day after you become consistent with 0.01s. Now, if you want to transition to higher lot sizes, take one trade per day, you guys. And it has to be at the exact high or the exact low of the day or of the previous day. Okay, let's go over the stop losses with these M and W formations. Now, here's our signature trade. Let's say we saw this play out. Why would we take this? Why would you take this trade? Not only is it trapping, are the dealers trapping liquidity at the low of the previous day, which is right here, the low of the previous day, if we're looking, if today is right here. So dealers are trapping at the low of this previous day, and they continued to consolidate. What do we know as consolidation? Consolidation is also a trap. It's also a trap, you guys. So we have two things in one happening here. We have our signature trade, and we also have this whipsaw. We have the up and down, right? The down and up. The whipsaw. So consolidation and then whipsaw. Come down, come up. But not only is there that, there is our signature trade. Where would you take this? Well, here's where the risk management comes in. I challenge you guys to take one trade per day. That's all. With listen, I'm not a financial advisor. If anything resonated with you in this entire video, please, I am lying to you. Do not trust me. Please do your own judgment. Please do your own research and learn this for yourself. Because I can talk all I want about this, and if you guys don't believe me, if you guys don't put this into effect, what's the point? Okay? So, don't believe me. I don't care if you believe me. I'm making these videos because it's fun. Okay? I'm making these videos because there are some people that believe me. And there are some people that are making thousands and thousands of dollars per day doing this exact method. So, believe what you want. This is what I do. This is what I've learned. The low of the previous day, the breakout to the low of the previous day, you would get in at the exact low. So, this is the exact low of the previous day. Now, what could you have done here? You could have seen everything that I've talked about in this video is what's happening right here. The consolidation at the low of the previous day, and also the wedge formation breakout to the low of the previous day. So, this is all, you've already learned this. Now, you would take this at the exact low. You could put a buy limit order at this exact low. You would have been in $3.6 pips of drawdown plus your spread. Let's make that 6 pips of drawdown, maybe 8 pips of drawdown on a trade that just went 155 pips in 5 hours. Okay, let's talk about the stop loss, the take profits. Now, a lot of times these are different. So a lot of times when I say different, you'll see these on different time frames. This is the 15-minute chart. If you see it on a 1-minute chart, obviously these play out on all different time frames, okay? You'll see them on 1-minute charts, you'll see them on 15-minute charts, you'll see them on the monthly chart. But you have to adjust your take profit levels to that time frame. Okay, if you're doing it on the 1-minute chart, you want to have 1 minute based take profit levels. You know, you don't want to go for hundreds of pips if it's a 1-minute chart. Obviously, you know, you guys use your common sense here. So the stop loss, I normally have a stop loss of no more than 30 pips. No more than 30 pips, and that's a lot for me. So my stop losses are normally 10 to 20 pips at most. Now, that's 6 pips of drawdown, 150 pip reward with a 15 pip stop loss. You're more than good. Okay, that's a 15 pip stop loss, 150 pip reward. Let's say you get out at 100 pips. That's almost a 8 times reward. 8 times, let's give it 7 times your ROI. 7 times what you were risking. You were risking 15 pips to make 100. Let's say 150, you did 10 times your risk. That's a 10x risk reward ratio. That's crazy. Okay? And that's just the start for these trades, you guys. Here's another one. Here's another very good example, actually. You could have taken this for 100, 150 pips, and then you could have seen this exact same thing over the high of the day, the high of the previous day, which we just traded. We could have seen, you know, we're starting Asian session. We don't want to go into Asian session with our trades open. We know the swap over will affect us as well. So we close out here our buy, and then we can see the wedge formation forming, the M formation at the high of the previous day, consolidation as well at the high of Asian session of the previous day. So the exact same thing that happened here, we're mirroring it. The exact same thing. Just a little bit different. Just a little uglier. Okay, this is a little bit uglier wedge, but it's the same structure. We have breakout to the high of the previous day. And it's also somewhat a 1, 2, 3, a triple top. And you can see, like I said before, the triple top, a lot of times the third leg is very volatile. This isn't super volatile. I mean, if you zoom in, it looks pretty big. Quite a volatile spike to that high, inducing traders long. And then we can see if you did get in at this high, that is a 200 pip ride down to the low of the previous day. But let's say we got out before, right when Asian session started, before the swap, we could have got 120 plus pips. Now, that's just in a few hours, right? That's in 14 hours. Now, that's in back-to-back, okay? One day to the next. That's over how many pips? Almost 300 pips collected in 2 days. Just right here, GBP USD. That's one pair trading one trade per day. This is real risk management, you guys. When I was trading in, I'm not going to lie, I started in wealth generators. This really crappy, I don't even know if they still exist anymore. I was told to trade like 20 to 30 trades a day, like scalping these like 10 pip profits for for 20 to 30 pip stop losses, it didn't make any sense. Sure, you won more than you lost in the trades. You won more trades than you lost, but you were losing because the trades, the ones that lost, would take all your wins. It didn't make any sense. This makes sense, you guys. And that was back when I was in wealth generators years ago. I had no idea how to trade. Thankfully, I stopped listening to the noise, to all the people that say, this is how it's done. They don't know it, okay? And I'm not saying I know it either, okay? I'm just saying I know what's worked for me, and maybe it'll work for you. So these are our signature trades right here. As far as the stop loss, like I said, it does depend on the pair. Obviously, you're going to respect GBP JPY a little bit more than Euro US dollar. Let's say, what do I mean by that? GBP, for example, is obviously going to have larger stop hunts just because it's a more volatile pair. GBP JPY, they may have 15 to 20 pip stop hunts as a norm. That's normal. That's pretty normal for GBP JPY. They could stop hunt to the low 15 to 20 pips, but yet reverse still. Whereas maybe Euro US dollar only stop hunts 10 or 12 or 15 pips. Now, these are just, these are variations. I don't have a spreadsheet or anything to, there's nothing that's basically perfect in the strategy. I can't give you a perfect template to overlay on this and you'll get it right every time. No, there are losses in this. There are obviously losses in Forex. I actually lost more trades this week than I won, yet I came out on top. I came out with over $2,000 of profit. Now, that may seem like not possible because I lost more trades than I won, but it is very possible because the losers are so small, 10 to 15 pips. I can lose 10 trades before I can lose 10 trades and then make up one trade what I lost throughout all those 10 trades. That's the beauty of these M and W formations. Now, what I like to do, a lot of people don't have time to trade London session. So what I've done previously is set my orders at exactly the low of the previous day. If I see, like this wedge formation forming or something similar, I will set a buy limit order at the exact low of the previous day. And I'll wake up with, more often than not, a lot of profit if it does play out as our signature trade. So here we can see, back to back, it plays out quite a lot. And this is just one pair, GBP US dollar. We can find it on lots of different pairs. Now, the take profit levels. Take profit, what I like to do is, once I'm in about 30 to 50 pips of profit, I will put my stop loss to break even or at 10 pips of profit. Just because, check this out. So let's say we got in somewhere around here. I wouldn't have placed my stop loss to break even until this candle shift out of this zone, out of this entire zone. This is the shift in the zone, and we can see price just moved up from there. Now we can see this zone shift is what caused price to completely move upwards, that parabolic move. But this is where we basically move our stop loss to break even after this shift out of this zone. And then we just leave the stop loss at break even and move it manually. A lot of people use trailing stop loss on MT4. Do not use that. That is garbage. Okay. I guess if it's your last resort, if you're sleeping, do use it because you don't want to get stopped out or lose any substantial profits. But if you do have time to manually adjust the TP and the stop loss, that's what I recommend. I recommend having a 50 to 100 pip take profit on these trades with just trailing your stop loss along the way. Now, let's say you trail your stop loss here, it wouldn't have gotten hit until probably right here or right here. And even that is about over 115 pips. So that's pretty nice. And then again here, let's say, we can see this. This is the shift out of the zone, out of this consolidation zone. We could have placed our stop loss at break even up here or in profit right around here, and price fell off a cliff. We can see that. And then even if we placed our stop loss right here, once again, we would have gotten stopped out at our stop loss. But if we had, let's say, a 50 pip to 100 pip take profit, our 50 pip would have definitely been hit, 100 pip possibly. But if we did have that trailing stop loss manually, we would have made around 50 pips still, 45 pips, something like that. Still very, very good return for a 10, 15, 20 pip stop loss. Keep in mind, the stop losses are very small. Now, also keep in mind the news. Now, let's say price is right here. This is the high. Price is right here, and there's going to be a news event, a very volatile news event. You probably don't want to have a stop loss. You probably don't even want to trade because you could have a massive spike up like we saw in Euro US dollar right over here. Let me check it out. Alright, so here's what I'm talking about. This stop hunt was very volatile, and if you did have a stop loss of, maybe 20 pips off of the high right here, let's say you sold right here, which would be a valid sell because it is at the high of the previous day, or the high of the day, excuse me, and I guess you could say, the high of the previous day is right here as well, and they're working this consolidation. You know what to do. Sell, but yet if this was a news event and we saw the price working the high yet and it didn't spike above the high and there was a news event coming, expect the news event to spike above the high, to spike that high and grab the orders, because that's what the news event is used for. That's the only reason the news event happens. One of the only reasons. One of the main reasons that news events actually happen are to trap orders and complete these structures like this. So, let's see, how big was this wick? This was a 18.7 pip wick. This was about 18 pips above the high of the day. Now, if you had a 20 pip stop loss, you may have been safe depending on the spread, but a 15 10, 15 pip stop loss would have been stopped out. And that's exactly what they were aiming to do with this structure right here. Let's go to EuroCAD. Here I have highlighted all of the Asian session consolidation ranges. Now, keep in mind this is the 22nd of December, the 28th, 26, 27, 28, 29. So this is holiday. We can see basically we have this holiday chop right in here, right? There's very little liquidity, but still we have the same structures being made. This consolidation, hit high, hit low. Consolidation, hit high, hit low. And then we can see that consolidation happened, and then that W formation, the low of the previous day was actually right here, and then the consolidation worked the low of the previous day, not breaking, did not break that low of the previous day, just worked off of it, and then came back up. EuroCAD stopped right here and consolidated a bit, and then we can see that same formation. That formation here, that spike up, also induced buyers, and we can see this little micro M, this little bugger, induced lots of people to buy in here. Lots of retail traders bought that, and then were trapped in this blue range that I drew right here. So there are trap orders. The goal was to trap orders at the high around 1.514, and then since there are trapped orders above this high, they can make another sweep at the high, but depending on how much money is trapped up there, they do not want to break above that high. So depending on the money, they will sometimes break above the high or sometimes not. So just know that you can still take a trade even though it's not exactly at the high. So sometimes right here we had the trade was 2 pips from that high, but remember, EuroCAD, how big is the spread on this pair? It's like sometimes 8 to 12 pips, and that's considered normal under normal conditions. Sometimes during news events it can be 30 to 50 pip spread. Just crazy. So we can see the micro M formation happened, like we said here. Within that micro M, we then have this macro M, and within that macro M, we have the second leg micro M right here, which actually was a wick, and the spread was opened to catch any orders above this high, and then it moved down. Price moved down. We can see it moved down off of Asian range. They consolidated and then waited all day. They created this high, this M formation, and then waited all day until NFP, all week basically, to drop this for NFP. After this big M formation was created, remember, the trapped liquidity is up here. Now where is it? Now where's the money? Price is down here. There are people trapped up here. If their stop losses here and here and here and here, these are all being hit. Okay. If their stop loss wasn't hit already and their accounts weren't already blown for NFP, they're still trapped up here. Take that into consideration. So I actually got into this trade for NFP just because I saw this M formation here, very beautiful M formation, and also this M formation right here. Structure tells it all, you guys. I got in a sell right around here before NFP even happened. 0 drawdown and over 180 pip trade. Not micro pips, that's 100. In one candle, it dropped 120 pips. Gold, USD JPY. Now, we did have a structure, an M formation on this pair too. We had the Asian consolidation and then the high of the day here. This candle broke above the high of the day, and then the next candle was the shift out of that zone and drop. But yeah, we can see the most important thing here is the consolidation. The most important aspect. I draw the consolidation up. The most important aspect is consolidation and highs and the lows. So if you don't know the highs and the lows of the day, you will not understand anything that I'm talking about. USD CAD, we also had that W formation here off of the low of the previous day. We can see the low of the previous day was here, right here, and then this W formation off the low. Price came up and then created the M formation high of the day here, maybe a little triple top there, and then that shift out of this consolidation zone. So the same thing happened. Consolidation, hit stops high, and then hit stops way low. Hit stops low. So another variation of our signature trade, where price comes to a triangle formation, a wedge pattern, and then breaks out, actually creates that little W formation at the low, creating that triple bottom, and then we can see in one candle this move is absolutely parabolic. Crazy. How many pips was that? 91 pips in one candle, 15 minutes. Amazing. Alright, you guys, you can see the potential for this. Hopefully you guys learned something new. I believe this is a very important video. If you did learn something, please share it with everybody you know that is struggling with Forex. I believe this can help a lot of people. It sure helped me. If you enjoyed the video, give it a thumbs up, a like. And before I leave, Happy New Year, and join us at forexcommunity.online. Nope. Online. Alright. Forexcommunity.online. If you want to type it into your browser, click enter. It will redirect you to a Telegram where we basically chat. We have a huge community of people, over 2,000 members that chat on a daily basis about different pairs. We send analysis. It's just a bunch of fun. So, thank you guys for tuning in. Peace out.